Well, my next guest says, despite the market slide this spring, many good things have been occurring. And Jim Paulsen is the chief investment strategist at Wells Capital Management. He says the soft patch is temporary. He expects a rally in the second half of the year. Jim joins us now live from Minneapolis. Welcome, Jim. Always good to have you on the show. So you think S&P is going to be where at the 1500 mark, excuse me, by the end of the year, or 1400?
Well, I think we might break 1,400, maybe 1,450 this year yet, Lisa. I think, you know, one thing about this, we've been in a consolidation in the market now since February, so it's 4 to 5 months old where we've been moving sideways. And I think market consolidations, you know, underneath all the concerns, or there's good things happening, and I see that going on here during this period. You know, we came in earlier in the year worried about runaway commodity prices and the impact they were having on margins. Well, we've arrested that of late. We were worried about runaway energy costs hitting household budgets. Well, we've stopped that. Gas prices are coming back down a little bit again. We had a big surge in bond yields, mortgage rates, corporate yields, treasury yields. And they've peaked since February, March, and treasury yields have fallen 75 basis points, as have mortgage rates. We were worried about a runaway U.S. dollar falling to record lows earlier this year. It seemed to have found a bit of late.
Well, let me ask you this, Jim.
I'm sorry?
I know you have a long list of all the reasons why, but what's interesting about your list is that many of those same things that you're pointing to are the things that bears would point to as a reflection of poor economic data. So the pullback in commodities, a lot of that driven by a slowdown in emerging markets, particularly in China. Right. How is that a good thing? Because you think the next batch of numbers is going to be much more positive?
Well, you know, we spent a good part of last year, Lisa, worried about an overheat in China, worried about a bubble economy that was going to crash. And emerging policy officials have been tightening, trying to moderate the recoveries. I think they've succeeded in doing that. They've created a soft landing, which I think, yes, it slows the economy, world economy down a little bit, but it probably means that we got better odds now out of elongated recovery. If China would have crashed, that would have been a much worse result. I think they've accomplished what they needed to accomplish. When I look ahead now, I think, you know, in the second half, in the first half, we had Japanese fallout on supply distortions. That will become a positive as they rebuild. We had terrible weather for 3 months nationwide that'll probably return to normal. We had a pickup in interest rates that have now been falling. We had a pickup in energy costs that are now falling. We certainly have checked optimism in the stock market, so we have bearish sentiment has increased, and then we've revalued the equity market, which is now selling below 13 times one-year forward numbers, and while the Treasury yield's fallen from 3.75 in February to 3% today. So I'm just saying that we do have some wind at the back of the boat with a lag that should make the second half look a lot better.
Jim, when do you start to see the turnaround? Do you think in the next month or so we're going to end June back in positive territory for the S&P 500, for the Dow, the NASDAQ, or is this more of something for the last quarter of the year?
I'm not as concerned because I'm not a trader per se. I'm more an investor, whether it'll be next week or whether it'll be 6 weeks from now when it starts to take off. It could be a sloppy summer yet. I don't think the market's going to go a lot lower than it was in February, March at its low of 1250 or so in the interim. But whether it takes off here in the next couple weeks or whether it's going to take the rest of this summer and we maybe get into the fall time before the numbers get better. We've certainly in a slow patch. There's no doubt about that, that the energy hikes, the interest rate hikes slowed us down. But I do think now those are reversed and we're likely to see better growth at least by the fall time.
Jim, a lot of our fate these days is tied to emerging markets. That's a sector that you like. But let's go back to China for a moment. You said they've managed to engineer a soft landing for their economy. But isn't it a little premature to call it a soft landing?
That could well be, Lisa. I think that's a legitimate point. I think people are still debating that. But I think what they've been trying to do for years, they've been tightening their money supply, they've been raising rates, trying to moderate the recovery. Now that we have data showing a moderation, people are quick to jump to, oh, that means it's really going to slow dramatically. Maybe it is, but what if it isn't? What if what they've orchestrated is exactly a moderation rather than a collapse? A year ago, in early 2010, they were growing at 12% real GDP rates. Now they've slowed to below 10, and I think if they grow between 8 and 10, that is going to be a plenty sufficient rate for the world, and it probably means no overheat and we have an elongated recovery. But you're right, we'll see over the summer here whether that holds up.
All right, Jim, always a pleasure to have you on this show. Thank you for joining us with your glasses half full outlook on the U.S. economy. That was Jim Paulsen of Wells Capital Management.